Good morning or afternoon, everyone. We're about to start. So let me just start with a quick introduction. Brian doesn't need one, but we're still going to do it. So I'm JC Abu Said, CEO and President of Halbert Hargrove, and I have the pleasure of introducing Brian Spinelli, Co-CIO of Halbert Hargrove, and he's doing the mid-year review. And as you know, this has been definitely an interesting year to say the least. Brian's been with the firm 18 years, and I've had the pleasure of working alongside him all these years. And without further ado, Brian, take it away, please.
Thank you, and welcome everyone to the mid-year market update. I'm going to go ahead and share these slides. Just some housekeeping items to start. If you obviously you've registered for the event, so you should have received an email from us yesterday with these slides. So if you have them, great. If not, you will also in about a week get another email with the recording of today's event along with the slides again. So I'm going to get going here. Everything I'm going to talk about today is going to cover essentially the first 6 months of this year through June 30. Just remember, data is obviously subject to change very quickly as markets change by the day here. So we're going to jump down. For those of you who are regular attendees for these market updates and these insights, I will follow a very similar format today, and you will see a lot of slides that look very familiar as far as the structure of them. The data has obviously changed, but I do want to keep this a little bit consistent because it's going to be things that we continue to look at. They don't become very stale, except for maybe the data, but they do remain important to overview. I'm going to cover public markets first. So think of U.S. equities, international stocks, and then the fixed income markets, all publicly traded, daily publicly traded. Towards the end, I will talk a little bit about alternatives, things that don't publicly trade. Second, I'll get into economic factors, some highlights of what's going on with the U.S. economy and the currency, and then obviously get into just one or two slides on good investment reminders and principles as far as an education standpoint. So let me jump down here to what I call the investment asset class Candyland chart. So for those of you who remember what Candyland is, this has a lot of colors, just like that board game. What you're looking at here across the top, 15 single calendar years. Every year that every year that we roll into a new calendar year, one of these will drop off because we can't extend the screens too far. But this one particular starts in 2010, finishes up through 2024, and then on the far right-hand side gives you where we're at year to date on a variety of asset classes. Each of these boxes is an index, a way to measure a market, a public market out there. They tend to be highly diversified baskets in each of these boxes. So what I'm going to do is look at the year-to-date column on the far right-hand side with you. And at the top, you'll see something that says DM equity. I'm going to have that term used in various charts today. That means developed market equities. So think of international developed companies that publicly trade. Light purple is emerging markets. And what you're starting to see here is in each of these calendar years, from top to bottom, the top box is the best performing asset in that period. And then at the bottom, the worst performing asset. As we look at calendar year to date, developed markets and emerging market stocks have been the best performing assets for U.S. investors so far this year. The asset allocation line is, think of that as a diversified portfolio of all of these boxes or all of these asset classes blended in a way to come up with something that looks similar to like a 60-40 type portfolio overall. High yield bonds have done pretty well this year, up about just shy of 7%. The green is probably the most widely followed or quoted box on a daily basis, and that's the S&P 500 up about 6.2 for the year. Commodities up 5.5. Bonds up a little over 4%, just shy of 4% this year. And then cash, which shouldn't be a surprise, is up about 2%. If you think about yields, like annual yields on cash right now being about 4%, halfway through the year, you've gotten half of that. And then REITs, or real estate investment trusts, publicly traded real estate companies, up about 1.8. And the only thing for the first half of the year in broad terms, that is negative is small US companies that publicly trade. Think of that as like the Russell 2000 index if you're looking for a specific area to measure that. What I do say with this chart is you'll notice things come in and out of favor very quickly. It's hard to really predict a pattern year to year. Sometimes across the top, what the best performer is in one year turns out to be one of the poorer performers the following year, and things oscillate quite a bit in this chart. If we move over to the left-hand, the farthest left-hand column here, these are the annualized returns ending in their 15 years of annualized returns for each of the asset classes ending in 2024. So this is not any new data relative to the last quarter I did, because the year to date is not showing up here. In that column, you'll just notice that US large cap, the S&P 500, has been one of the strongest performers over the last 15 years. I do caution that do not use this to think that this is all going to repeat exactly the same in the next 15 years. I will address valuations and things like that in a moment. But I will say that within this lineup, a couple things stand out. Fixed income at 2.5%. The point being made here is if you're a fixed income investor today, most of your return can be projected by looking at just the yield if you're a buy and hold investor. So starting yields matter. We are not at a point of starting yields of 2.4% any longer. With interest rates being much higher now, fixed income investors probably should have a better outcome over the next 15 years, assuming they're buy and hold. I cannot say that's a guarantee because I get fired over that, but just to use fixed income as an example, we have been at ultra low yields up until about 2022 when rates started to change quite a bit. So a lot of that 15-year period captured periods where yields on just overnight rates were at zero from our Federal Reserve, and fixed income was slightly higher than that, but yields were nowhere near where they are today as far as interest rates are concerned. Let's talk about US equity valuations. You've seen this chart before. The gray squiggly line is just tracking one measure. There's multiple ways to measure valuations on markets, but this is the price to earnings ratio currently that's the S&P 500 is tracking on. And you'll notice that when the squiggly line goes up a lot, like it did in the early 2000s, valuations got very high. As the line declined closer to the financial crisis in 2008, 2009, valuations got very inexpensive. That means people were selling all their stocks or selling stocks in a heavy amount. Valuations got very cheap, presented a really good buying opportunity for the next 15 years. Where we're at today is we saw in March and April this year, I've been saying this to a few clients, if you went to sleep on February 20th and you woke up on around May 16th, you wouldn't have known there's any volatility in the public equity markets. Things had gone down a lot and then jumped back up and recovered. And so same thing happened with valuations. We saw in that red box on the far right-hand side, we saw valuations cheapen a bit because in March and April, there was a lot of selling going on. Valuations on companies were going down. That started to bring down the level of valuations on the market, which is not necessarily a bad thing. We have since seen a recovery, and the S&P is back up at the same level it started the year at as far as valuations are concerned. It's trading at about 22 times earnings. If you want to use that as a rough rule of thumb, you're essentially at today's prices, you're buying 22 years of earnings on the broad baskets of stocks that make up the S&P 500. So by a number of these valuation metrics that you see on the screen here, in that box that's in the middle, most things are trading well above their 30-year average as far as valuations, indicating that the US market remains expensive. Let's boil down the index a little bit further on the US market because only I would say at this point, the S&P 500 index, while it is a diversified index, it has 500 stocks in it. It is not as diversified as it once was because roughly the top 7 to 10 names in the index, the largest companies that comprise the index, make up an even greater share of the index returns today and influence the index than they did in previous periods. And we can kind of see this if we slide over to the right-hand side. The gray is the top 10 largest valued companies within the S&P 500. So the more valued, the higher value the company, the market cap, the bigger percentage weighting that it represents within the index. The top 10 companies are just shy of 40% of the index at this point. So 10 names, close to 40%. It's 38.2, but let's just round up here. The other side of it is 32% of the index earnings. So if you think about earnings on all these companies that make up the index, 32% of the index earnings are attributed to the top 10 names in the index right now. So it's a much more concentrated index than it has been over the last 30 years. And that's why you kind of can see that gray line going significantly up since 2016. If we slide over to the left-hand side using the same price to earnings ratio we were just talking about on the previous slide, you can see in the gray there, the current valuation metric, that price to earnings ratio on the S&P is at 22. The remaining 490 stocks, if you exclude the top 10, is trading just shy of 21 times earnings, when historic average roughly is about 16 times earnings. The top 10 are the ones that really stand out here, trading almost 29 times earnings at this point in time relative to their historic average of about 21. So those companies represented, the top 10 represented in the green, really have been moving. But as I'm going to show you here, something has shifted this year. Doesn't mean it's permanent, but something has shifted this year, which is a welcomed outcome in markets overall. And the theme here is that we've seen a broadening out, meaning more and more companies within the index have contributed to the share of the return of the overall index this year than the previous 3 years. So if we just look in the center of the screen, there's a red box around share of returns, and you can kind of see from 21 to 24, particularly calendar years 22 through 24, the Magnificent Seven. So think of those companies all the way from Apple, Amazon, Google, Meta, Tesla, Microsoft, and NVIDIA. Think of those names making up the Magnificent Seven. For the last 3 full calendar years, they've made up over half the return of the index, meaning the reason why the S&P was up was over 50% of it was driven by those 7 names. This year, we've seen a little bit of a change and more breadth to the market, in which those companies have only contributed a little over 20% of the return this year, whereas the other 493 have really driven up most of the return this year. About a little shy of 80% of the returns this year are attributed to companies outside the Mag 7. If you slide over bottom right-hand corner of the chart, this is just looking calendar year by calendar year, the return dispersion between those 7 names. And you'll see in certain calendar years, particularly like 2023, the best performing Magnificent Seven company was up about 239% in that year. The worst performer up about 48%. This year, we've seen a lot more of a compression, less spread between large outperformers within the Magnificent Seven versus large underperformers. The spread is the best performer right now for the first half of the year is up 26. The worst performer's down about 21. And my guess is you could probably guess the down 21, which is Tesla at this point in time. Before I move on to international, I do want to address volatility. This sometimes serves as a good reminder, but in this particular calendar year, if you were paying attention to markets in late February, March, and April, you saw volatility come back with a vengeance in markets again. And it really, at the end of the day, was not abnormal behavior for a stock investor. What we're doing here is we're looking back over 45 years of market history going to 1980. And what you're seeing here is the S&P 500 and the return of the S&P 500 for that calendar year in the gray bar. If it's above the 0, it means it had a positive return. If it's below 0, it had a negative return for the year. But I want to focus on the red dots. The red dots simply represent the worst drawdown investors experienced in that index during that calendar year. It doesn't mean it was the only drawdown that occurred in that year, but it was the worst drawdown. When you really look at this across time, on average, you should anticipate or should expect something like a 14 to 15% drawdown in markets in a single year. It's just a very normal behavior to have volatility in public stocks within intra-calendar years. Most of these of the 45 years here, the market finished positive a little over 73% of the time though. So even with drawdowns, investors did have positive outcomes a little over 70% of the time within the US stock market. And as you can see, just over on the far right-hand side, this is just a running total of where we're at for the year. Doesn't mean we're done with the volatility. It just simply shows that we did get close to a bear market this year in US equities, down 19%, so just shy of the bear market territory of 20%, despite we've had a significant recovery here in, essentially late April into May and continuing on into this year. The index is over 5% now for the year. So even with that, a lot of pain that you experienced, particularly early April, it's a very quick V-shaped recovery that we've had so far this year in equities. Let's spread it out to beyond US stocks, because US stocks aren't the only game in town to invest in, and look at what other areas did. So what this chart's going to represent is the best performing asset class on the left, working over to the worst performing asset class on the right, but show you the drawdowns in red. So the peak to trough decline. And what you can see in the first column there is developed market or international equities drew down about 15%. They're up about just shy of 20 through the end of June this year. So even though the volatility was there, if you could stick with it, you've had a pretty good experience with it for the first half of the year. Emerging markets also drew down about 12. High yield bonds, or think of below investment grade fixed income, down about 3.5. I already touched on the US large market, down almost close to 19% at one point. Commodities were down about 9. US just traditional investment grade fixed income down about 2.5. Cash doesn't change. That's the point of cash. It should be stable. So obviously a zero drawdown on cash. And then small cap US companies drew down close to 25%. And the one that I'm going to hit on when I get to the international section today, because it matters to you as US investors, is the dollar declined peak to trough about just shy of 12% this year. So it's come back a little bit before the end of the quarter, down about 10.7% here. So the dollar has depreciated this year, which helps US investors, as I will show when I get into the international section of this. So let's move outside the US equity markets and look at just international stocks. Even with that outperformance I showed you on the previous chart, where you saw close to plus 20% returns out of the international side, the US, when we're looking at price to earnings ratios of international companies versus the basket of US companies, international on the left-hand side is still trading close to a 35% discount. It's not the cheapest it's been in recent history, but it's pretty darn close to the bottom on that chart. We've had other periods, as you can kind of slide over to earlier, the turn of the century here, post the dot-com bubble. International was at a steep discount. It rallied before the financial crisis and caught up and was actually trading at a price to earnings premium to the US markets, meaning it had done a lot better. Valuations had gone up a lot. But for the last well over 15 years, the valuation discount on international has been pretty significant. Typically, though, international does usually trade at a valuation discount to the US of about 17%. But this is double that at this point in time, which presents an opportunity. Good fundamentals, cheap prices. International is priced not expensive at this point at all. And then if you are thinking of dividend income and thinking of revenues to your portfolios, if you slide over to the far right-hand side, international stocks, even with the valuation bump they got this year, where they've run up in price, they're still paying about just shy of 2 times the dividends the US market is paying on a broad basket at this point in time. So I'm not advocating you dump all your money into international and get out of US. That's not the point of this. It's just to show you that not all of the world is trading at a significant valuation premium at this point in time. And there's valuations, good valuations to be found outside the US and good fundamentals. Let's talk about let's move over to how international returns have been influenced by the dollar decline. So if you think of yourself as a US investor, when you go to invest in international markets, you're going overseas and having to convert currency. And then on a daily basis, that gets converted back into dollars to price your performance, essentially. And I'm going to use a couple indexes here to describe that 10.7% decline in the dollar for the year. So if we look at the AC World US Index, there's a red box around about 4 different areas on this chart. All the AC means is all cap world index excluding the US market. EFA is another way to measure international developed, but the all cap world index ex-US does include emerging markets as well, whereas the EFA index, EAFE and EAFE index does not do that. It only includes international developed markets in it. And what you'll look at in the year-to-date 2025 column, you'll see local and USD. So the US dollar, return on the ACWI World ex-US index was about 18.3% for the first 6 months of this year. If you didn't have the dollar impact in that and you just kept it in local currency terms, the return was about 9.2. It's nothing to sneeze at, but you can kind of see that big disparity of what the dollar decline tailwind did for international diversification in portfolios. Same thing under the EFA. You'll notice the pretty big spread, close to 10%, once again, driven by the dollar. Emerging markets were a little less sensitive to that, but they still got a little bit of a tailwind of about a little over 5% from the dollar decline. So that's the impact. If you stay in local currency, you got good returns, but the US investor that was converting dollars was essentially got an even bigger tailwind out of the international outperformance this year. So let's look at the dollar move on a chart over time here. So I'm going to look at the left-hand side of this slide and only focus on that today. You'll notice that the dollar does go through periods of significant decline and significant increase. It's called the dollar cycle. And we've gone through a number of these periods before. What we're going to look at today is just where we've been since 2022. The dollar in that red circle there, you can kind of see that it started to peak in September of 2022. It declined and then it had some volatility before this most recent period, this calendar year, where the dollar has declined pretty significantly. It's nothing as big as some of these previous moves that you can see. So, you know, if you go back to the early 90s where you almost saw a little over a 50% decline in the dollar, this is not anywhere near that magnitude at this point. Doesn't mean it can't keep sliding, but the dollar did go into 2022 pretty darn expensive relative to a basket of international currencies and has since given some of that back. A lot of that is being driven politically right now, but it has not had nearly as a significant move as it has in the past. So I just wanted to remind investors that dollars do go in cycles. It doesn't mean just because we've had an 11% decline that we're losing reserve status or anything like that. It's just the nature of the dollar being pretty expensive in 2022 and giving some of that back at this point, which in a way was probably a correct move on the dollar overall. Moving over to fixed income. So this is where a lot of the time we will focus more of our efforts on active investing versus passively investing. So think of like an index fund or something like that within US equities versus if you move over to the fixed income index world, the most commonly used fixed income index that people talk to is something called the Bloomberg US Aggregate Index. Before the financial crisis really got underway, it was once called the Lehman Aggregate Index. Lehman's no more, so Bloomberg took it over. But what I want to look at here, along the bottom in each of these bars that you see, are various areas of the fixed income market. So the biggest one here is US Treasuries on the far left. Then you have agency mortgage-backed securities, you have investment grade corporate debt, you have municipal bonds, and some other like small amounts of other fixed income in here. The point of showing this is at the top of each of these bars represents how much debt is outstanding in these various areas of fixed income. What's the total issuance that's on the market today? There's about $26 trillion of treasuries that are sitting on the market at this point in this, as far as an opportunity set within, when you scour the broad fixed income market in the US, about 11.5 trillion of mortgage debt, 9 trillion of corporate debt, and then you can kind of see it staggers down pretty quickly here. Within the construct of this index, so think of like when I talk about the S&P 500 earlier, the more valuable, the higher the market cap of a company, the bigger weight it represents in constructing the index or the measure. In this case, the bond indexes work differently in the sense that they overweight the most indebted issuer. So if you think about the US government, in this case, treasuries, they have issued way more debt, 26, at least in this case, $26 trillion. So they make up an even greater percentage of the overall index return. So if you're just passively buying this index, you're buying more and more treasuries as the US issues more and more debt. Agencies, about of the $11.5 trillion, about 66% of those are in the index. But what you can kind of see here is more debt, the more debt an issuer has, the greater weight they have in the index. And I think that really represents an opportunity for an active fixed income manager to be able to go into other areas of fixed income and not just necessarily weight their allocations based on how much debt somebody has issued. So I've showed it differently in the past, but on the chart I went over in Q1 of this year, or in April of this year after Q1, I did show the treasuries of the index, the way the index is constructed today, treasuries make up a little over 45% of the index. So there are ways within fixed income to be highly active and to be able to not just buy what this index is weighted towards. The other thing that you are hearing in headlines, and it was pretty prominent within the month of April, was talking about treasury yields and treasury auctions. I just want to kind of take you back to the red box on this screen and look at the US Treasury yield curve. So this is just looking at various maturities across the US Treasury issuance at this point. There's the 2-year, the 5-year, the 10-year, and the 30-year represented on this chart. I won't talk to tips today, but what you're seeing here is at the end of 2024, so coming into this calendar year, those are showing you in those, call it 5 core areas, where yields were at and where yields are now relative as of June 30th. These are moving around a little bit in the month of July, but the point being is we started the year with higher yields. Almost all of these except the 30-year bond actually saw a decline in yields this year. So we saw a little bit of loosening or decline on interest rates this year, which has helped fixed income investors have positive returns this year, in addition to the coupon or the interest rates that they're getting paid every month. So in this case, yields are not nearly as high as they were coming into the year. They have been pretty darn volatile though overall, particularly if you watch the 10-year, which I do every single day. It has bounced anywhere around, the 3.9 range all the way up to 4.5 this year, and it's been moving all over the place. It's done that in the last week, for example, but we're not in any different interest rate territory as far as yields are concerned right now versus the start of the year. And that, as a reminder, don't confuse this with what the Fed is doing. So the Fed controls the overnight rate. That's the rate that you will hear the president try to say they need to lower the rate. They need to lower the rate. These rates are determined by the market. So even though the Fed may lower rates, the market, the people that are actually buying the bonds and willing to loan the money to the US government might say, hey, you're at a point where your credit quality wasn't what it used to be. You have more debt than you did, and we're concerned about that. And we demand a higher rate of interest in order to do that. That's what causes yields to rise. That is not controlled by the Fed. And so in this case, you may get a lower overnight rate, but these rates might not change. They might go up. So it's just to remember the market controls this, and the Federal Reserve does not. Moving on to the economy side of the equation. So I'm going to cover a few slides on the economy here. So this is just looking at the gross domestic product quarter by quarter, the rate of change at which it's gone through. And in the first quarter, so around April 30th, so after I did the last update, we got a negative GDP print. So that's what on the far right-hand side is showing that the first quarter GDP print showed that we had declined about 0.5%. What stands out here and why the market necessarily hasn't freaked out about a declining GDP rate is that purple box that you see there, and that's covering the net exports. So what happened in first quarter that led to that purple bar becoming bigger than it's been in any of these other periods is essentially importers front-running tariffs. They imported a lot more than was exported from the US, and they did it in droves, which drove that number to be a much bigger detractor from GDP. What we'd anticipate is we will get a GDP print for Q2 or a GDP estimate for Q2 on July 30th this year. And what we would anticipate is that you're going to see that shrink quite a bit. TBD can't tell you exactly what's going to happen, but it does look like we might have gotten a negative GDP print followed by something that might be in more positive territory for Q2 this year. We saw something similar happen in, if you slide over here on this chart, you saw something similar happen at the beginning of 2022 as well. So it's something to watch. Most important with GDP is the consumer. The consumer makes up about 70% of our GDP here. So if the consumer slows, that's really what's going to dent GDP for the long term. Moving over to inflation, I got this chart approved by compliance, and then the next day we obviously got our June GDP, our June inflation print. And at May, just remember these are year-over-year numbers. So looking back 12 months. So this on the far right-hand side of this, you're looking at an inflation rate year over year of about 2.4% in May. That print just came in, it's about 2.7. So inflation has crept up a little bit here for the month of June. The real question on markets' minds right now is what, if any, inflationary impact is going to come from tariffs. The data has been kind of slow to show up in the inflation numbers. No one really knows exactly how much this is going to impact inflation. There are different theories on this, but we have seen a little bit of the tariff impact the month of June at this point. And if you're wondering which areas of inflation of this basket, of this CPI basket, are probably most sensitive to the tariff impact, you're looking at the orange, which is core goods, the food at home in purple, and green, which is energy. So those are kind of the three more sensitive areas. Everything from shelter to dining out and auto insurance, those are going to be more less impacted by tariffs overall. And the two that have been the most stubborn, I would say, of the basket have been shelter and auto insurance rates. They've been slowing down the rate of increase, but obviously it's not going to happen overnight. These things tend to take a long time to decline overall. So if those continue to decline, they may offset some of the other things that are more inflationary or more impacted by tariff at this point in time. So it's something to watch with inflation because the market's watching it. There's a little bit of a discount going into it as far as inflation not getting out of control again, but that is definitely a worry and why you are seeing our Federal Reserve stand still on cutting interest rates at this point in time. We did have tax legislation passed called the One Big Beautiful Bill. And what I wanted to kind of just show you is the trajectory of debt to GDP. And I'm going to focus only on the bottom right-hand corner of this today. And you can kind of follow the debt to GDP percentage here. So a lot of the time you'll hear our debt to GDP in the country is 100%, and it's continuing to get worse. When we look at this, you can kind of see where we were at in the gray bar or the gray squiggly line over on the right. We were just shy of 100% at the end of 2024, and the CBO forecast right now for what the One Big Beautiful Bill will do for the next, call it, decade, you can kind of start to see here that we were already on a path of increasing debt to GDP, that ratio, and this slightly makes it worse at this point in time. There's no political commentary involved in this. I'm just saying we were already on this path. The way to fix it, really, at the end of the day, where you want to start seeing that decline, is either GDP is going to need to go up a lot more than what's currently forecast, which it's pretty slow. So the rate of growth of the economy needs to go up, and the rate of spending needs to go down, or the rate of borrowing needs to go down. In this case, the One Big Beautiful Bill doesn't solve that, at least on the forecasted basis. And remember, we always discount forecasts because no one knows the future, but my guess is that's at least in the right direction of change, which is not great to see, that we continue to increase our debt to GDP as a country. So that's the main impact of that tax bill on that debt to GDP ratio, which is also influencing the treasury markets and the borrowing rates that the US government pays. The topic of recession, I'm not saying there's a recession. So before you see this slide and go, oh my God, there's a recession coming, I don't know. And it doesn't look like it right now for this calendar year. But I did want to talk to what the National Bureau of Economic Research uses when they call a recession. And let's look down at the bottom of this slide. There's really 6 core inputs to what they use to determine if the economy is contracting. And those areas over the last 6 months have been continuing to grow. So there's not within this data right now, there's no recession call. If we look at the colored coded boxes up above, you'll see those same 6 categories over time, how they go from green to orange to yellow to red. The way to think about that, green is really positive, yellow is slowing, orange is getting, close to negative or just above negative, and then red really is, they're all negative at a given point in time, which would be a recession call. And you can kind of see there was really 2 core months of 2020 across the top. So that was the pandemic where the economy shut down. Everything turned red, and that was the very short recession we had in 2020. Most people have forgotten that recession because it was so short-lived. But where we're at today, things have been slowing. The data has been getting softer. It's not necessarily, it means that it's all going to go red. It's just meaning that a number of these indicators right now are moving closer and closer to what would trigger or be caused by a recession. Most likely any recession that we're going to have is going to be caused by some outside event that was unforeseen. That causes the economy to contract pretty quickly. But the data has been softening. It is not as strong as it has been in previous periods. But at this point, I would just say it's soft, but not in negative territory, leading to a recession call at this point. And as a reminder, by the time the NBER calls a recession, I will tell you that most of the time, public markets have already reacted to it months in advance. The markets are forward-looking, anticipating. Most of the time, public markets have already reacted and priced in a recession by the time they call one. I call this the soft data chart because it's not hard data like the previous chart, but this is just more looking at consumer confidence, which can be extremely volatile. Just look at the gray line. It goes up and down, up and down. It's more volatile than stocks on how people feel about the overall economy. And one of the things that we pointed to last time was that consumer confidence had taken a real big nosedive in April. Since then, in that red box on the right-hand side, it's improved pretty dramatically again. So it's gone back up. It hasn't gone back above that dotted line that you see there. But one of the things to just note here is when consumer confidence generally hits a bottom, so like in all these periods where you see those really big downs and a blue dot on there, there's a percentage next to it or underneath it. So in that case, that's just showing you that when consumer confidence bottoms or has bottomed historically, that the next 12 months out of US stocks has been pretty darn good, because this is a US indicator. It's not an international indicator, but relative to like risk assets, so thinking of stocks, when consumer confidence is bottomed, which it did in April, stocks have generally done pretty well. And we've seen that kind of play out here in a very short period of time as well. Consumer confidence bottom, market recovered. So just a soft data point, but the consumer is not nearly as depressed as they were in April. And we'll see what that shows up in the next few months of surveys. The last thing on the economy, I just want to focus on what the Fed and the market are expecting, because this is an area of volatility for stocks and even bonds. It's just it's a point of what market expectations on overnight rates are going to be from the Fed versus what the Fed is saying they're going to do. And the main thing to look at here is just focus on the blue diamonds and the green diamonds. And you'll see the path of what the Fed thinks they're going to do with interest rates at this point, lower them, like the path of lowering them versus what the market had priced in as of June 30 here. And you'll notice there's a spread between the two. So either the market's right or the Fed is right. And what this can lead to is volatility in publicly traded assets. Because if you think about it, if the market is too optimistic on cuts, and then they realize they were too optimistic, that generally leads to negative volatility. We have seen this over the last many years, or I'd say over the last 3 years. You'll get periods where the market and the Fed are disconnected and quickly correct, and then they'll do it again, and they just keep doing it. We're just in another period here where the market is a little bit more optimistic than the Fed is on cutting rates at this point in time. These are going to be, I'm going to group the next two, and then I'll open it up for questions. These next few slides are more just good reminders. So I talked about just what recessionary indicators were, or what the factors were to call in an official recession. I just want to go back to what the left-hand side of this is looking at is where we've had recessions, how long they've lasted in each of those periods, and then what the ensuing expansion was. And what you'll notice there in the blue is recessions tend to be a lot shorter than the expansionary periods that follow. And there's one thing on this chart that doesn't stand out. And I will say, if you look next to 2009, the tiny little blue and then the big gray, the one that goes up to a little bit over 60 months there, that's actually 2020. So the labeling doesn't fit on this chart, but 2020 was essentially a 2-month recession, and we're still in technically the expansion, which has been a little over 5 years at this point. So that's why the gray bar is there. That's still a running total. It's not a finalized thing at this point. But if we take all these various recessions over US history, in this particular chart, you'll see that the average recession was about 14 months, whereas the average expansion ran about 50 months, just shy of 50 months. They're all different. They all have different expansion periods. We've seen some pretty big long-running expansions in the last 15 years here since the financial crisis, leading up into the pandemic, which is why that gray bar stands out well above all the other ones. And then looking at what really, if you slide over to the far right-hand side, the size of the bubble is essentially trying to measure how big the decline in GDP was. And what you can kind of see there is GDP in the financial crisis, the 08-09 recession, GDP declined about 3.8%. The pandemic was pretty massive at 9.2, but very short-lived. A lot of that, not a traditional recession due to excesses. It was literally a pandemic that shut down the economy overall. So just as a reminder, if we do we will end up in a recession at some point. Just as a reminder, as an investor, those tend to be shorter lived than the expansion periods that follow, and you don't want to miss those expansions. Let's look at bull and bear market territory. So think of a bear market like I described earlier, a 20% decline. We didn't quite hit one this year on the intra-year decline that I showed you on the S&P 500. But looking at various periods where we've had bull markets and bear markets, the thing below the black dotted line on the x-axis here, so it's 0%, what you see are these various periods of declines up here. And what you'll notice is that the decline in the equity markets, while it's extremely painful, so if you think about a number of these hit peak declines of 50% on US stocks, the expansions that followed those tend to be extremely long and extremely violent on the upside. So if you're not careful and you end up being a seller down after all the pain is felt, the chance of missing some of these expansions is pretty painful because you essentially locked in your losses and didn't get back. A lot of these, when you look at them, while the declines were down about 50%, your average recovery was about 2.5 years, meaning to get back to even. So relatively short-lived to very long-running bull markets. So in these cases, the bear markets usually average a year and a half, close to 2 years in some cases, whereas the expansions last well over, or the bull markets last well over 5 years on average. So just keep that in mind. Stocks are volatile. They do go down. I know we've been in a period where stocks do nothing, well, except for March and April, where stocks have done nothing but provide great returns. Just remember, as a stock investor, you might have periods where you can get cut down in half. And that stresses why diversification does matter in portfolios. The last slide, this is going to really address why private markets matter in a diversified portfolio. So a lot of what I've said today pertains to the public equity and the public fixed income markets. So if we start here over on the far right-hand side, you'll see a bubble with a blue slice, a big blue slice, and or a big green slice and a small blue slice. That's just a generic portfolio of stocks and bonds. It's a 60% stock, 40% bond portfolio of publicly traded assets. If you take that and say, I want to include private markets in there for added diversification and different sources of returns, that's what HH, assuming we can do that with your portfolio and you can have less liquidity from the portfolio, private markets start to make a lot of sense in the sense that if we start looking at these various areas, so for example, the big purple dot that probably stood out to you right off the bat, direct lending, that is one area. It's not the only area, but it's one area of the private credit markets. So think of that like fixed income, but not publicly traded. Also in a smaller dot, because the yield is not, meaning the income you get off the investment versus the appreciation is pretty small. But if you look at private equity, for example, very similar, you're buying companies just in the public market versus buying public companies in the public markets. Private equity has been able to reduce some of the volatility of your portfolio and still provide a high level rate of return. Direct lending, which I addressed first, high level of yield, interest income that generates, also bringing down the volatility of the portfolio or the reaction that it has to the public markets. And by having some of these different private alternatives in portfolios, you're able to bring down the volatility of that 60-40 portfolio, the public portfolio, and still have access to a source of return that is quite competitive in an overall portfolio. So private markets do provide diversification, and there's a lot more outside just public equities. But as a reminder, when you're investing in private markets, these are long-term investments. You cannot liquidate them daily. but they do provide a diversification and return benefit that we think is important in just overall portfolio construction for long-term investors. So those are the prepared comments for this period. If you have questions, please use the chat function down at the bottom and type in your question, and I will try to address them. And I do have one question that came in here. So thoughts on how Powell's replacement will affect the market. So it depends how it's done. And we kind of saw that yesterday. It's a very contemporary topic where Trump had said, I'm going to fire Powell, and then denied it later. We saw the market kind of react negatively. A quick replacement of Powell probably is not great for confidence and probably would cause quite a bit of volatility, negative volatility, particularly in the fixed income markets and also the equity markets. And we kind of saw that start yesterday with the notion that he was going to fire and replace Powell immediately versus saying, no, that's highly unlikely. We saw the market recover, but replacing Powell and firing the Fed chair abruptly would not be something the market's going to the broad markets are going to react kindly to. Let me see if there's any more questions coming in. I don't see any more questions coming in at this point in time, but I wanted to remind you, if you are a client of HH, your advisory team has all of these slides. And if you have questions directly, we'd love to hear from you. Please reach out to your team, or you can reach out to the firm and we will try to address these questions if you do not have an advisory team with you at this point in time. So thank you very much. I look forward to seeing what Q3 brings and providing you an update around October of this year.